Welcome to the Profit Answer Man. Matthew Sercely, it's great to have you join us today.
Thanks for having me.
I am excited for our conversation. Can you share a little bit about yourself and your business?
Sure. So I am an attorney and a tax planner or tax advisor. I've been licensed as an attorney for 15 years now. I started my current business in 2020, actually as a reaction to the pandemic and my previous job maybe not being around because of the pandemic. But I'm also a serial entrepreneur. I've had, by my count, at least 14 different business ventures, and that's just like since I was in college. Like I remember doing stuff as a kid on the school bus selling stuff. Most of those business ventures made no revenue at all. I just spent money. I was looking for something to do, and I did. I bought the courses. I bought the, how to do fulfillment by Amazon, how to do copywriting, all these things. I had a couple that made some money, but not profits. I spent $1,000 to sell $100 of stuff on an e-commerce site. I've had two that I really consider profitable. My current business, and I also do real estate, which has been very nice for me. But I've wanted to be in business. I've wanted to have my own business for a long time, and I think I finally found something that works for me, which is really exciting.
Nice. It seems like that's a journey for many of us, right? Trying to figure out market fit of our talents, what we enjoy, our expertise into a market and figuring out how to make it work. And I think the problem is, and you mentioned it, some of these things, especially the ones that entice you, like, oh, make all this money doing XYZ, most people don't really make money. Like whenever someone says FBA and trying to do e-com, my hackles immediately go up because I know what the margins look like. And I'm like, that's going to be a tough business. And yeah, copywriting's phenomenal and good copywriting is worth tremendous amounts of money, but it's one of those things that you have to have that natural skill set. It's like being a major league player. You've got to have something behind you that
That's my
you're
favorite
really good at.
example for a lot of these things. Like I have a client who does fulfillment by Amazon. He makes a lot of money. He makes more money than I do, frankly. But 99% of people who do fulfillment by Amazon make almost nothing or lose money.
So when you say he makes money, we're very impressed with the bottom line. Does he actually clear profits that he gets to take out of the business?
Yes, yeah, he does
Okay.
very well for himself. But
And
even then, he's also been really smart. He's moving into his own storefront. Like he still does FBA, but it's like, I want my own email list. I want my own customers instead of Amazon's customers. So even the successful guy understands, like, just because it's worked for him for the past while, it may not work forever. And the other thing is, I think he's been doing it for 9 years, and he didn't make a lot of money the first year or two.
we had an episode on that with Neil Twa back, and it's about picking the right products, and then it's about moving them technically off of Amazon into your brand, or having those private labels that you can build your own following on.
Yeah.
So today we're here to talk about how to pay less in taxes, because when we are successful and when we do have profits, and I don't know how much people realize this, but if you've got a highly profitable business, the government takes a very, very large chunk. And so people like to play games with taxes, but I think it's also a skill set that needs to be used appropriately. Too often, people are just trying to save on taxes while they're losing all the money that they're doing something with to save on taxes. So be wise about it. And I want to start with tax prep versus tax planning, because I think a lot of people go to their tax preparation person expecting them to help them save taxes. And that's not what they're geared to do. That's not what they're set up to do. You do much more of the planning side, correct?
Correct. So a tax planner is somebody who's going to sit down with you now and help you figure out what you need to do, what changes you need to make, whether starting to do something or stopping doing something, so that when you prep your taxes next year, you owe less money and you get to keep more of it. I do tax prep. This is actually the first year I'm doing tax prep. But my primary business is the advice, the planning side, basically using the IRS's own rules against them.
And I love to do that. And people don't realize just how messed up that entire system is between the IRS says this, but the tax court says that. And good luck calling the IRS. They've even said just because we tell you something doesn't mean it's true. They themselves are incompetent at their own set of rules, and knowing how that is and taking an appropriate stand. And then the other thing I have found is if you have the right people on your team who are helping you take the stand, the IRS is I don't know if the word's intimidated, but they're more likely to accept something from someone who's got some sense of an authority behind them.
Yeah, ultimately the IRS is, well, it's made of people, and people are lazy, especially government workers. And so while occasionally you have some diehard IRS agent who really is busting his butt because he thinks he's, going to save the country by collecting all the taxes owed, most of these people, they just want to get paid their paycheck and go home. And so if they see, a really easy $1 million score, essentially, they're going to go for it. But they don't want to waste 40 or 50 or 60 hours of their time and then justify that to their boss to find $500 in unpaid taxes. In fact, I mean, they don't get bonused based on what they collect, which I appreciate, because in some countries and a few states they do. But it definitely does get factored into things like promotions and raises. And so again, like they want to hit, they want to find that guy who cheated the government out of $500,000, not the guy who cheated them out of $500.
It's the 80-20 rule. It's the same thing that we tell business owners, right? Go where you have the best opportunities to make money. And everybody's the same, so they're doing the same type of thing on their end. So let's talk about it. What are some great ways to save taxes that maybe aren't so obvious to people?
So there's two primary ways to save taxes in any business. The first is getting your structure set up correctly. Should you be taxed as a corporation or a partnership? If as a corporation, what type of corporation? And then the second major way is going to be finding business deductions, especially maybe money you're currently spending on your personal life that you can turn into a business deduction, or finding ways to, like, not every dollar a business spends is necessarily deductible. You have to justify it. So if your company is spending money, being able to justify it better so you can deduct more of those dollars you're spending is a great way to do it. One of my favorite examples, this is a relatively recent thing I was even turned on to, but I have a client who really wanted to buy a new firearm. He likes going shooting, he likes to train, and his business, he's a tech worker, basically a software engineer who has his own company. He has like 7 clients. And so when I think, what the hell does buying a gun have to do with that business? Well, what it has to do with his business is any business can invest in security for the business. And he has a server on site, a backup server on site with some of his clients' information that he has a legal obligation to try to safeguard. And so we worked together and we basically drafted a couple of documents, and he bought a pistol, a training class, and basically essentially is going to go shooting every other month and pay for all the ammunition and the range time. It's going to be a $3,000 business deduction for him this year. That's money he was going to spend anyway. Like, he wanted to do this for himself, but now he found a way where it's a business expense and not a personal expense. That's going to save him $900 in taxes.
And it's a lot of these little things. It's about thinking through it and realizing where to put it on the tax return.
Hmm.
It's not so much, there's a lot of nuance in that. And if you know, hey, if I put this under security, it's deductible. But if I put this under office equipment or whatever you would want to call it, it's not deductible. And having the sense enough to be able to do that. But then also, and this is, I think, the other part that people don't realize, when a CPA signs a tax return or an authorized preparer signs a tax return, they're also on the hook too. And so, just like the person who works for the IRS, they don't want to take undue risk. Like, you're paying me $1,000 for do your taxes and you want me to take all these risks. Why am I going to do that for so little of return? So, it's finding the right people who will think that way and are willing to support you in being able to do that. Now, one of the things you mentioned to begin with was corporate setup. And I know, like, I just notice everyone is always like, oh, subchapter S, subchapter S. Like, without thought, they throw that out. And I think that is somewhat of a mistake. I think there are multiple ways to look at stuff. I think the other problem is they look at things in the short term versus not looking at things in the long term. So maybe a tax structure is good for today, but if you've got a long term goal, it may not suit your long term goal. So it might be better to pay a little bit more today if you're hitting your long term goals of whatever that happens to be, because changing structures cause all kinds of issues. And I think people don't realize how many issues they're come up with changing structures.
Yeah. So that's absolutely true. And in fact, it's been interesting. I've now had several people come to me in the past 6 or 7 months who had worked with somebody else to do tax planning. And I'm just kind of shaking my head at some of the stuff they did. And yeah, it's like almost everybody seems to say, put everything into a Section S corporation. And the fact of the matter is, that's actually really good tax planning for a majority of small businesses, but not all of them. There are some times when it will actually cost you money compared to just being a sole proprietor. One of the ones I saw was it was a family business. And one of the great things about having a sole proprietorship is if you hire your kids and they're under the age of 18, there's no payroll tax. But if you're an S Corp and you hire your kids, there is payroll tax. Well, this guy was very successful and was putting a lot of money to his kids, which then they were using to pay for, to save up for college and such. The S election was actually costing him about $3,000 a year more than it was saving him. And so it's like that, there's lots of general advice out there for taxes, and general advice is great. That doesn't mean it's good for you. And the state you're in can matter. It a lot of things that work really great for somebody in Texas may not work for someone in California because you have to worry about the impacts on the state taxation. One of the very first tax plans I did, I found a way to save a guy in California nearly 15 grand in his federal taxes. The problem was it was going to raise his California state taxes by $19,000. We didn't do that.
Well, because you actually looked at it, and I know, like, Tennessee has special rules for S corps, and they have other taxes on them, and different states have all of these different rules, and so you have to think about that. And it also comes down to, if you're employing your kids, if in the future you plan on passing your business down, it's going to be different, sole proprietor versus S corp. Like, all of these bigger decisions come into play, and you've got to have the conversation up front, and you've got to have a plan up front of what you're trying to accomplish, because otherwise at some point you're going to pay the bill. And the other thing is, though, with S corps, from my understanding, if your reasonable salary is above the S corp, or not the S corp, but above the Social Security cap, there really doesn't become much of a benefit to the S corp at all, is there?
No, in fact, it's a complete loss at this point because of the qualified business income deduction. You lose it's a 20% deduction on your income, and you completely lose that on any portion you pay for salary. So even people who aren't over the limit, like I've seen this, people making maybe $100,000 a year, but they really can't justify a salary lower than $80,000 a year. If they're an S corp, they probably do better as a sole proprietorship. And once you factor in everything else, they certainly do better. Because let's be honest, while I hate taxes, I don't want to pay taxes. My goal is not to pay no taxes, because that's simple. Make no money. My goal is to have as much money as possible after I pay my taxes and after I pay everything else. So this is another thing that I have, and frankly, I wasn't good at this the first 6 months I was doing it either. But like, there were a couple clients I had who was like, "Great, you're saving $3,000 a year in taxes, but now you have to pay unemployment on yourself. Now you have to pay workers' comp on yourself. Now you have to file all these additional forms. It's taking you 30 hours of compliance, and it's costing you half of your tax savings. Well, maybe it's not worth it." Like, that's one of the other things I look at. Like, if you're making 10 grand a year, forget your taxes. Go make more money. Like,
I,
yeah, maybe you'll find a way to save $500 in your taxes, but it's a lot easier to find $1,000 in revenue in the same amount of time.
I think what I see is the opposite side. They're making a lot of money in revenue, and so then they go for this tax planning, and they don't actually look at the fees of the tax planning. And what I mean by the fees are, okay, I understand with real estate that you can do a cost segregation.
Hmm.
But doing cost segregation requires a cost segregation study. Those studies can be expensive. There are some people who will do captive insurance. Yes, captive insurance is a great way to save on taxes, but the study for captive insurance is $30,000 to $50,000, and then there's ongoing compliance and so forth. So when you do these things, I think it's important to look at the entire picture at the moment. What is the total cost, and then what's the long-term thing? I just heard a guy talking on tax and oil credits, and
Yeah.
the thing with, and he made the comment, and it drives me nuts because this is what I see. Oh, if I invest in this tax and oil deal, I don't have to pay taxes this year. I save $30,000. Yes, you do, but you made $100,000 investment. And the average return on most people who do this on their $100,000 investment is zero. Do you know how much 100,000 times zero is? Zero. So that means you saved 30 grand on taxes. You lost $100,000 in this silly investment. You're minus 70,000, but nobody connects those dots. And
Or
I bang my head.
or even a much more common thing, the people who buy a car to save money on taxes. And it's like, I see all these people talk about, I see these gurus talk about it like, look, you can buy a friggin' Tesla and pay no taxes. And it's like, well, if you want the Tesla, that's not a terrible idea. But if you've already got a car that's a good car and you don't need a new car, but you go out and spend 100 grand on a new car, you're out the 100 grand, even if you save 30 or $40,000 in taxes. And again, like, there are absolutely people who should buy vehicles in their business. And frankly, I've advised clients to maybe accelerate a purchase by 6 months or a year that they're planning on making because of a benefit to taxes. But if you've got a 2-year-old car, you don't need to buy a new car to save taxes. Find a different way to do it.
But so let's take that example. 2 years ago, I bought a truck, and I depreciated the entire truck 2 years ago, and so I saved on taxes.
Mm-hmm.
So it's 2 years later, and well, now I need to save on taxes again. So I'm going to go buy a new truck. So I'm going to trade in my truck, and I'm going to buy a new truck. What they don't realize is when you trade in the truck and you got 70% back on the truck, you
That's
have to
income.
recapture all the depreciation. It's only the difference between the old truck and the new truck. So you spent a whole bunch of money, and that, I don't think people realize that at all. There's a lot of different moving parts, and here's why they don't realize it. None of them actually look at the details in their tax return. All they do is, did I get a refund? Yay. I'm like, excuse me, that's like getting change at Walmart. That's not something we dance about, right? I hand the guy 100, he gives me 20 back. It's not $20 found, but yet that's the way people treat their tax returns. They don't actually look at it. And when I look at them and I compare them to their QuickBooks, and I say, well, wait a minute, all these things that you thought were a tax deduction, like meals, not properly in certain categories, the tax guy goes, oh, these aren't deductible. They put them over here. Charitable deductions, right? If you're below the itemized, it doesn't matter that you gave $5,000 in charity. Doesn't count. And so if you don't understand what they're excluding and including and being clear on it, then you can't make those things. So like when it comes to charitable, I will tell people, look, rather than a $5,000 donation to your church, why don't you advertise in your church bulletin for $5,000? Okay? Because now that charitable deduction may or may not have given you a deduction, but the advertising did. It's like your gun story, right? The same thing. You put it in the right category in the right way, and it's doable.
Well, and another thing is just keeping track of the changes in rules. So right now, maybe you have a deductible meal expense. Well, you only get to deduct 50% of that meal expense under the current rules. And it's changed every single year how to calculate that for the last 5 years on just meals. There's no more entertainment expense. The whole, buy tickets to a ball game and take a client is not deductible currently. It used to be. It probably will be again. But right now, entertainment expenses, 0% deduction.
And your CPA is not going to call you up and go, hey, I didn't take that entertainment deduction. They're just going to move it to another category, shut up and move along because they don't want to have a conversation with you.
And it's amazing, again, just like there are so many little things going on. And also, this is the place I see a lot of really smart people get in trouble is they're good. They go out and they learn the basics of the tax code, the basics of the rules, and they don't understand when something has special rules. So, for example, I love travel deductions. If you are in a small business and you are not basically turning some of your vacations into business trips, you're doing it wrong. But cruises have very special rules. If you want to take a cruise as a business deduction, good luck. Like maybe some of it, maybe you can write off $2,000 of your $5,000 cruise. But if you're, maybe you would have done something different. Maybe you would have gone to an all-inclusive resort that was 100% deductible instead. So all of the, and again, the same thing with cars have all these special rules in multiple different areas. Like most things you buy, you can write them off 100% in the first year if you're a small enough business. Cars have special rules when it comes to that. But I've seen so many people go out and buy, like a Honda Civic and say, oh, I'm going to expense this in my first year. No, you're not. There's no current way to do that in the tax code. Can't do it.
No, you can't. And that's the other thing. Like when it comes to depreciation, people don't realize you're not actually saving more when you accelerate depreciation. All you're doing is changing when the taxes are paid. Because if I accelerate depreciation into this year, the next year I don't have depreciation. And so next year I'm going to pay more taxes. And you have to sit down and look at the big picture. And in that case, you've got to plan out 5 years. Does it make sense in this particular year to do it? And that's also the end of year tax planning. Hey, do I need to move income into this year or to next year? How do I want to handle my end of year? But all the things we're talking about, I think the problem is most people have this discussion in February or March when they walk into their CPA's office or their tax person. This is a conversation that occurs in June for the following year. And it's an ongoing every year discussion because every year I get bulletins in the mail. Here are all the changes. Here's what is now deductible. Here's what isn't. Here's this special rule. Here is this opportunity. Here's a ruling of the tax court. And the tax court said XYZ, which has changed everything. And so if you're
Not to
not,
mention, they put out the whatever the dirty dozen list, or the, these are the things that either we're saying they're fraudulent now, so don't try them, or we're telling you they can be legitimate, but you're basically guaranteeing an audit if you do it, so make sure it's worth it. That, like, again, some of those things are the same thing most years, but ERCs maybe not a great idea. Now, if you're going to save $50,000 and it's legit, do it. But if I had a client who was going to save $1,000, I would highly advise them to consider not taking the deduction, which I don't normally do. Like, I'm a big believer of let's go fight them out, but like, that's something that, especially if it's a little iffy, I'm usually, better to ask forgiveness and permission, not on the ERC, which is the employee retention credit. Like, that's a big one.
I have never seen such a cluster of a mess, and I have never seen the IRS be so proactive in saying no. Like they literally stopped accepting they didn't stop accepting them, they stopped processing them. In the midst of everybody doing this, they red flagged it, audit.
Mm-hmm.
And but the part was, and the thing that people don't realize is there was all of these, I'll call them tax mills,
Yeah.
running around telling you, hey, we'll do this for you, we'll do this for you, we'll do this for you. You can save, you can get hundreds of thousands of dollars. You paid the tax mill the 10, 20, 30% that they charged. You got your refund, right? Especially if you did it early.
Mm-hmm.
But here's the problem. 3 years from now, when you get audited, because the IRS is not fast, and they take your $200,000 back, right? They're going to penalize you.
Mm-hmm.
You're also now probably going to be on the audit list, right? For the
Mm-hmm.
future stuff. And that company that you did business with, they're gone. Good luck getting them to represent you. Good luck getting your money back. Now you're out not only for the check the IRS handed you, but the fees you paid them, plus all your taxes and penalties. And it's funny because a few years ago, people would be like, "Yeah, we'll just take installment agreements with the IRS because where else can I get money for 2 or 3%?"
Mm-hmm.
Today, the IRS is charging, I don't know, 7, 8, 9. I don't even know what the current rates are,
I
but
it was over 9% when I checked it about a month ago.
okay, so the IRS found out about inflation and higher interest rates, and they've hiked the rates that you're paying them. So you really have to pay attention to this, I think.
Yeah, it some of that just falls into the, if it sounds too good to be true, it probably is. Um, you know, Again, especially with some of the returns people were getting on that ERC credit, like, a sophisticated business person should have basically gone, hold on, is this really how this works? And again, sometimes yes, that's really how it works. But, like, I mean, I was an employee when, I had my business, but I had a job working for somebody else, and I remember him talking with me about it, and I was basically like, man, I think you actually qualify, but like, my back of the napkin math is you're going to save 5 or maybe 10 grand, and these guys telling you you're going to save 50 grand. I'd be really careful. And he went to his CPA. His CPA found a specialist in the area that his CPA knew he personally was going to be on the hook if he brought a shyster in. And they did it. And yeah, my boss actually saved about 11 grand because of this tax credit. Um, and he felt a whole lot better than if he had saved, 50 grand and then was going to pay back 100 grand later.
But he also probably paid a couple grand to get that all done.
He did. That was the other thing. It was not a percentage. It was an hourly fee. So it was not $3,000 or $4,000 to get that done either. So no, the other thing is, I mean, there are people on YouTube who give absolutely fantastic advice on taxes. I'm actually kind of surprised. I follow several channels just to get ideas. But some of the things I see some of these YouTubers say about taxes is just damn terrifying. I mean, from the basic thing of like, oh, if you want to buy a camera, start a photography business and expense it. It's like it's a little more complicated than that. If you just go to the IRS and say, I have a business with $600 of expenses and no income, they probably won't bat an eye. But if they do, and if they ask for documentation, they've called that tax fraud on some people. And tax fraud is when you potentially go to jail. You know, I'm willing to be very aggressive if the penalty is, you know, I think I'm going to save 30 grand by doing this. And maybe if I'm wrong, I got to pay back 40 grand in the future, but it's a good chance I win. Sure. I am not willing to take 100 grand in savings if the penalty may be at 6 months in prison. That's not a good deal to me. That's a very bad cost benefit analysis.
And I agree with you. You know, the one tax deduction that I absolutely love is one where you get to keep the money, but it doesn't seem to be, I don't know if it's not sexy, if it's not prevalent. It's just, or maybe a lot of people just do it. And so it's commonplace. It's literally putting money into your own retirement account. Because if you follow the rules, and there's a whole bunch of different ways of doing this, and it's all very situational on you specifically. You can put a lot of money away tax free or tax deferred, actually, because at some point you're probably going to have to pay it. But there's even ways to get out of that by doing all kinds of wild conversions later on in life. But you have to understand what it is. I just don't understand why more people just don't fund their retirements. And there's a bigger reason for this too. And I think it's what was that? Is it The Road to Babylon? What was that old book on saving?
Oh, yeah. I know exactly what you're talking about. Richest Man in Babylon.
Richest Man in Babylon. It was just simply, look, every business is a risky opportunity. And if you take 10%, and I think 10 is low, but if you took 10% of all your profits and you put them away in these retirement accounts, even if things blow up in the future, you're guaranteed your retirement, you're guaranteed that nest egg, you're guaranteed the ability to do things, and we can get into some really cool tax planning where we use those retirement accounts to buy real estate or do other kinds of wild and crazy things. And the people who are really good at it have actually put billions of dollars into their Roth IRAs. So
Peter
I
Thiel. You're talking about Peter Thiel.
well, so did the politician oh, I think he might even be out of Texas. McConnell, right? Not McConnell. He's an older guy. He didn't he run for president once or VP?
I don't know. Yeah, there's something like a current estimated 7 to 10 people with $1 billion plus Roth IRA out there. I agree with you and I disagree. First of all, if you don't have a business, if you're just W-2 employee or contractor, retirement accounts and actually HSAs, I like even more, usually, which are health savings accounts. That's about all you can do.
Mm-hmm.
Like there's not a whole lot of tax planning you can do as an individual until you're a multimillionaire. Um, I think that there are downsides to IRAs, and that's it hurts your liquidity. Like, yeah, you can take the money out for penalties, but it's like it's especially for a newer business, I don't like it necessarily. Now, once you're making tons of money, once you got more money than you know what to do with, it's a great thing to do. And especially if you're a solopreneur or you got maybe like your kids or your wife working your business, it's possible to put away 70 grand a year for yourself and 70 grand a year for your spouse. tax-free in a solo 401k. Now you have to be old enough to do that, or it's only $62,500 each.
And you
You
could
can
put
put away
money in your kids' Roth IRAs when they're teenagers, and they'll never be taxed again on that.
that's one of my favorite things to do, especially again if money's tight, pay your kids and then have them pay for things you'd pay for. And I do this.
Mhm.
I have a 12-year-old child who's in Scouts, and I pay my child, and my child pays for new tents, new backpacks, camping trips, fees, etc. And I'm just saving money on that. If I were totally financially set for life, I would pay my kid more, and I would make sure that $6,500 is going into that Roth IRA, because yeah, that's one of the best tax deals there is. Because the Roth IRA, you take, not only do you pay no taxes when the money comes out when you're ready to retire, you also can take your principal out at any time tax-free, making it more liquid, and like it's a far better savings device for college than a 529 plan. I hate 529 plans. They got a little better this year, just a little better this year, because you can actually now convert the money into a Roth IRA starting this year. But even then, maximum $30,000 per person. So if you put 50 grand in your 529 and then the kid doesn't go to college, well, what do you do now? No, the Roth IRA for an under 18-year-old especially is fantastic. And it's amazing. You can pay your kids this year nearly 14 grand, completely tax-free, and get a write-off for it. Has to be a reasonable wage. You can't pay them 14 grand for 10 hours of work. But it's amazing what you can do. You were talking about kind of thinking outside the box, and that's one of the things I encourage my clients to do. A good question is this deductible? A much better question is, how can I deduct this? And maybe the answer is you can't, but it's a better question.
And I agree with you. When it comes to liquidity, though, putting the money in the retirement account, I think, is better than buying the truck, because at least you keep the money. And that's it. Yes, you do need liquidity to do these things. And you also need to be profitable to do these things, because if you're not profitable, you don't have to worry about taxes. And that is not a good way out either.
Or again, even worse, I've seen some people in non-profitable S corporations where they were paying themselves a salary, so they were paying payroll tax to themselves, where if they were sole prop, they would have owed no tax at all. Again, another one of those, the good rule for most people can be really bad advice for you in particular.
So true. If people would like to learn about you and your tax planning services, what's the best way for them to do that?
So I set up a webpage for your listeners. It's agoristtaxadvice.com/profitman. That's agorist, AGORIST, taxadvice.com/profitman. That will take them to a page where they give me their email and they get a download with over 60 business deductions. Again, just to get those juices going. Oh, I didn't know I could write that off. I didn't know I could write that off. Get you thinking about it. It gets you on my email list, where I send out about one email a week on a tax topic, about one a month on a business topic, any big changes in regulations, and there's also ways to contact me then through there.
Cool. And I will make sure to put that in the show notes. Thank you so much for joining us today.
Great to be here. Thanks so much.
Thanks for listening to this unedited video of the Profit Answer Man podcast. If you'd like to catch the full episode and learn more about what we do, check us out at profitcomesfirst.com. We also go through the Profit First book in each and every chapter in the beginning episodes of the podcast, so check those out as well. Thanks for listening, and here's to you having a more profitable and growing business.